How exactly does a company growing its revenue at nearly 66% a year end up trading for less than half its sales? That is the ultimate curiosity gap in the market right now. When you look at Oscar Health, if you just pull up the headline numbers, you see a business that just reported absolutely massive growth, and yet Wall Street has basically priced it like it's going out of business. So today, we're tearing down the ultimate misunderstood underdog story to figure out if this massive valuation disconnect is a trap or literally the turnaround opportunity of the year. Okay, let's dive straight into the core of the tension here. 0.4 times trailing price to sales. I want you to anchor on this number because this is what makes the whole story so fascinating. You look at the broader US insurance industry and they trade at an average of 1.1x sales. You look at managed care peers, they're sitting around 0.6x. Meanwhile, Oscar is sitting in the absolute bargain bin at 0.4x, despite taking major market share away from legacy giants. The market is screaming that something is fundamentally broken here. But as you'll see, the underlying math tells a totally different story. This brilliantly illustrates the conflict we're dealing with. On one hand, you have blistering hypergrowth. Oscar has compounded revenue at 65.9% annually over the last 5 years. They went from $462.8 million back in 2020 to $11.7 billion in 2025. That is staggering scale. Yet, despite all that, you have this incredibly compressed 0.4x multiple. Wall Street is basically saying, we don't care how fast you grow, we just don't believe the profits are real. So our job right now is to figure out who has this right, the hypergrowth reality or the deep skepticism. So to figure out if Wall Street is completely missing the boat here, we need to look at what Oscar actually does and how they make their money. If you view Oscar as just another boring legacy health insurance provider, you are entirely missing the plot. They are a cloud-native, full-stack consumer tech platform that just happens to monetize by disrupting a $1.6 trillion legacy healthcare industry. They're targeting individual enrollees, gig workers, entrepreneurs, and employees who are migrating away from those traditional group plans. And the economic engine under the hood is what's really interesting. Oscar doesn't use the fragmented legacy claim systems that the national incumbents use. They literally built their own platform from scratch called Plus Oscar. They've also rolled out something called the Lucy Health Marketplace. This is huge because it acts as an AI-powered storefront for brokers and enrollees to buy ancillary coverage like dental and vision. Why does that matter to us as investors? Because those are capital-light commission streams. They generate revenue without requiring Oscar to hold heavy statutory capital reserves. And then you have their ICHRA solutions, which is basically a system where employers give their workers tax-free dollars to just go buy an Oscar plan on the open market. So the big question is, does the tech actually work? Yeah. It really does. 89% of members interact with Oscar's digital or care team channels. But here is the killer stat. Their proprietary AI bot, Oswell, now resolves 86% of incoming member inquiries. When open enrollment hits peak volume, these AI super agents reduced response times by 67%. They are structurally driving down administrative costs, and frankly, that is exactly how a disruptor beats an incumbent. But look, let's be intellectually honest for a second. The market isn't stupid. That 0.4x valuation exists for a very rational reason. To understand the opportunity, we absolutely have to understand the market's core fear. And that fear boils down to extreme historical underwriting volatility and a massive structural dependency on the federal government. This is what Wall Street calls the subsidy cliff. Check this out. Approximately 93% of Oscar's premium revenue is funded by federal subsidies, specifically advanced premium tax credits. When the American Rescue Plan Act passed back in 2021, it pumped enhanced subsidies into the market. But those enhanced credits expired at the end of fiscal year 2025. The bear case here is terrifyingly simple. If those subsidies dry up, healthy people drop their insurance, the risk pool gets significantly sicker, and the entire individual exchange market contracts. Oscar actually priced its 2026 plans anticipating a 20% to 30% market contraction, just to be safe. Now combine that subsidy risk with their balance sheet, and the tension really peaks. At the end of 2025, Oscar had a highly leveraged position, $5.34 billion in total liabilities against just $980.7 million in equity. They recently had to take out a $475 million secured credit facility just for operational liquidity. But that money comes with major strings attached. If quarterly premiums drop below $3 billion, or if parent-level liquidity drops to $100 million, they breach their covenants. The market has been terrified, but even a slight misstep in pricing could trigger a downward spiral. So the table is completely set. High growth, massive tech advantage, but heavy debt and federal subsidy risks. The narrative was overwhelmingly negative until May 6, 2026. Oscar reported their Q1 2026 earnings, and it fundamentally altered the thesis. This was the exact moment the stock rallied off its lows and pushed up toward the $30.68 mark. Let's look at the hard evidence. Analysts expected Oscar to earn $1.11 per share. Instead, Oscar dropped a massive $2.07 per share. That is a staggering 84.8% positive earnings surprise. No joke. Now, revenue of $4.65 billion was actually a slight miss on expectations due to some risk adjustment accruals, but the bottom line is what really mattered here. Net income skyrocketed 147% year over year to $679 million. Operating earnings surged. They finally proved they could convert top-line scale into actual cold hard cash. Here is exactly how they pulled it off. The medical loss ratio, or MLR, which is just the percentage of premiums they spend on medical claims, dropped almost 5 full points down to 70.5%. That was driven by highly disciplined pricing and a $68 million favorable reserve runout. Meanwhile, that AI technology we talked about earlier, it drove their SG&A administrative expense ratio down to 15.2%, which is the lowest in corporate history. The end result was an operating margin that expanded by a massive 5.4%. And by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed, because what we're seeing here is the rare moment where operating leverage finally kicks in for a hypergrowth company. But listen, one blowout quarter does not magically create a bulletproof long-term investment. We have to weigh this Q1 2026 inflection against Oscar's historical execution. To do that, we use a qualitative scorecard to look under the hood at the reality of the business. Synthesizing the most critical factors here, market position is a phenomenal 9 out of 10. While giants like United Health and CVS were scaling back, Oscar stepped on the gas. They nearly doubled their share to 30% of their operating footprint, hitting 3.4 million members. Management alignment is a solid 8 out of 10. Back in April 2026, CEO Mark Bertolini put his money where his mouth is and bought 1 million shares on the open market at $11.92. He still retains over 7.75 million shares, even after some planned tax withholding sales. But you have to balance all of this against the track record, which only gets a 5 out of 10. Let's not forget, before this huge Q1 beat, they posted a $443 million loss in fiscal 2025. They have a history of volatility, and they absolutely still have to prove they can stay profitable all year long. Now I want to take a quick second to mention that all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for literally any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. You also get Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of your screen right now. Scan it to download the Flash app and try it yourself, or just access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Before we map out where this could go over the next 5 years, I need to say this clearly. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. We're assigning probability weightings to 3 distinct paths: a 50% probability to the base case and 25% each to the high and low cases. When we blend these together and factor in a 1.5% annualized share dilution from stock-based compensation, the probability-weighted equity valuation target sits at $71.85. But the price target alone doesn't really tell you the story. The underlying assumptions do. Let's walk through what actually has to happen operationally for each specific scenario. In our base case, we assume Oscar continues organic enrollment and hits $36.29 billion in revenue in year 5. If their AI efficiencies hold up, they stabilize at a 3.5% net margin. Apply a historical mid-cap 16x exit multiple to that, and you get an implied price of $63.12. But look at the low case. This is where things get ugly. If the ACA marketplace contracts severely due to the subsidy cliff and adverse selection pushes the sickest patients onto Oscar's books, those margins compress to a razor-thin 1.5%. The market slaps a 12x multiple on it, and the stock bleeds down to $15.48 over 5 years. Conversely, the high case assumes their ICHRA products see rapid employer adoption, and the Lushi marketplace really scales those capital-light commissions. Revenue scales up to nearly $47 billion, margins hit their long-term target of 5%, and a 20x premium multiple yields a massive $145.67 implied price. By the way, if you want to access the full model with all the detailed assumptions for each scenario, you can check out the full research report at flash.stocksentinel.ai. Now, to be a smart investor, you can't just stare at the upside scenarios and ignore the cliff. You have to know exactly what could break the thesis. What are the early warning signs that tell you that 0.4x valuation was actually a giant red flashing warning sign and not a discount? Here are the concrete threats you absolutely must monitor. First, sequential increases in the medical loss ratio. Underwriting is highly seasonal. Q1 is usually their best quarter because patients just haven't hit their deductibles yet. If MLR spikes aggressively as we head into the fourth quarter, the margin turnaround is basically dead. Second, you have to watch parent-level liquidity. If it ever gets near that $100 million floor, they breach their debt covenants, and that gets messy fast. Third, specialty drug costs. Specifically, GLP-1 weight loss medications are acting like an absolute wrecking ball to underwriting margins right now across the entire sector. Finally, geography. Oscar's members are incredibly concentrated in Florida, Texas, and Georgia. If regional hospital networks in those states consolidate and start flexing their pricing power, Oscar is highly exposed to those localized cost spikes. So let's bring the whole story together here. We opened with a massive curiosity gap, a hyper-growth tech disruptor trading at a shocking 0.4x sales discount. We've seen that the discount stems from very real structural legislative risks, specifically around the federal subsidy cliff and their historical unprofitability. But we've also seen the Q1 margin inflection. The AI is clearly working, the SG&A costs are dropping to historic lows, and the CEO is buying shares on the open market. The ultimate question, and the thing that resolves this whole tension, is consistency. Oscar is proving the skeptics wrong right now. But the true test of this turnaround comes with the Q2 earnings slated for August 6, 2026. If they can sustain that margin inflection through the seasonally tougher quarters, that 0.4x multiple is going to look like a historic mispricing. If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.